Namaskar friends, welcome to the channel JIB and CIB Made Simple. Today we are going to bring you part 2 lecture of our memory based question which appear in the examination on 26 July on a special request from many candidates. I have already created part 1 lecture and from request many candidates have requested, that's why I am creating the part 2 lecture in which I will explain the further more question in very detail. So if you have not seen the part 1 lecture, I am providing the link in the description section. So let's get started with our first question that we have. So this is regarding the mutual fund returns. Very good question asked in the previous year. The question is, a mutual fund manager review the fund annual result, right, to assess how much value has been added above the market standard. See the keyword they have written, how much value has been added above the market standard. What is the correct formula for the excess return in the portfolio analysis? So the question is asking you to tell the correct formula for excess return in the portfolio analysis. So there are 4 options. Option number A, portfolio total return minus benchmark index return. Option number B, portfolio total return divided by benchmark index return. Option number C, portfolio total return plus benchmark index return. Option number D, benchmark index return minus portfolio total return. So the basic question it is, you have been asked to compute the excess return. So let's look at the option number A. Option number A says, that portfolio total return minus benchmark index return. This is actually the correct answer. Why? Because excess return also called active return. Either you call it excess return or you call it the active return. Both means the same, right? So it simply means it measures how much extra the fund made compared to the market, right? It measures how much extra the fund made compared to the market. Imagine that your fund made 12% this year, right? And the benchmark index rate, let's say Nifty 50 is 8%. Right. So how much excess return you have? You have 4% excess return, right? So this means your fund add 4% extra value above the market standard. So that is exactly what investor want to know. That's why option number A is correct. If you see option number B, it's completely wrong because dividing does not tells us the exact value added. It gives a ratio, not the actual outperformance. So option number B is wrong. Option number C is also wrong because adding the return together does not make sense here. You are adding total return. This does not make sense. Right, you are not trying to combine the fund and the market. You are trying to see how much your fund beat or lagged the market. So C is wrong. What about D? It says excess return is equal to benchmark index return minus portfolio total return. This is tricky because it is just the reverse of the correct formula. If your fund see, 2 things can happen. Your fund can outperform, right? If your fund outperform, this would be a negative number. Investor want to see how much you added, not a negative value. So it is not the standard formula. Right. So remember, the correct answer to this question is option number A. So remember these key points, right, about the excess return. I'm just telling you just summarizing the fact. So it is also called the active return. First point, please keep in the mind. Excess return or the active return, both are the same. What is the formula? Difference between the portfolio actual return and the return of the chosen benchmark. If you subtract actual return and the chosen benchmark return, it will give you the excess return. And if the positive excess return, it means fund outperform the market, right? A positive active return indicates the fund outperform the market. A negative excess return, it means fund underperformed. It shows value added by the fund manager. It does not show the absolute return. It highlights how much manager value addition has been done. It does not tell you the absolute return level, right? Simple tips. Always subtract the benchmark from your portfolio return to see the real performance difference. I hope this is crystal clear. Now friends, let's have a look at the second question that we have. So friends, question is, over the time, liberalized financial regulation have encouraged which of the following trend in government and corporate bond market? Option A, appearance of more volatile and opposing trend in domestic and offshore yield curve. Option B, creation of isolated domestic and global security market with very limited interaction. Option C, gradual alignment of yield movement between local currency and global currency denominated bond. Option D, development of unique yield curve for each individual institution. So which option do you think is correct? Basically the question is asking you about the trend. Which trend in government and corporate bond market has been encouraged by the liberalized financial regulation? That's the question. So let's look at the option. So friends, if you look at the option Option C says, gradual alignment of yield movement between local currency and global currency. Yes, this is the correct one. Yes, option number C is the correct one. Why? Because when financial regulation are liberalized, basically this question is about, liberalization of what? Financial regulation. Try to understand. When financial regulations are liberalized, restriction on cross-border investment are reduced. See, cross-border investment, right? Cross-border investment, whatever restrictions is there, it get reduced because of the liberalization. As a result, domestic bond and foreign currency bond start moving in a similar way, right? So what happened, local currency bond, global currency bond, they start moving in a similar way because the restriction has been removed, right? And a similar US dollar bond, right, which yielded 3%. Okay, after liberalization, what happened? As global investor move money between markets, so these yield tend to move together. So this difference was, bridged, right? The gap was reduced, and these yield tends to move together depending on the global interest rate and the risk. This shows that, better integration of the market, right? That's why option number C is correct. What option number A say? A says appearance of more volatile and opposing trend in the domestic and offshore yield curve. This is completely wrong. This is opposite of what is happening. Liberalization break barrier. It does not create isolation. Rather, it break the barrier. Right? It encourages cross-border flow. It encourages, more integrated market. So that's why option number A is wrong. What about option number B? It says creation of isolated domestic and global securities market. See, this is the opposite of what happened. I told you, liberalization breaks barrier rather than creating isolation, encouraging cross-border flow. So option number B is wrong. What about D? D says development of unique yield curve. Yes, that is exactly incorrect. Why? Because while different institutions may have slightly different yield due to credit risk, basically liberalization aligning market-wide yield. What liberalization does, they alignment is being done, right? They align the market-wise yield, right? Rather than creating unique curve for it. No, they don't create unique curve for each institution. Rather, the focus is on market level convergence, not individual uniqueness. That's why it is wrong. So here is what you need to remember. First thing is that liberalized regulation reduce barrier between domestic and global bond market. So ultimately what happened, barrier get reduced between domestic and global market, barrier get reduced. First point. Second point, it encourages cross-border investment. Cross-border investment is encouraged by the liberalized regulation. And third point, result is that local currency bond yield start moving like a global bond. You can see, resulting in yield for local currency bond increasingly moving in a tandem with those of the foreign currency bond. That is the final outcome. So I hope if this made you clear, please hit that like button. And if you are looking for a study material for CTP examination, we have a study material available on our app. App name is JIV and CIV Made Simple. For more detail, you can WhatsApp me on this particular number for more detail. Now friends, let's look at the next question. So the question is asking you regarding the advanced option pricing. I'm skipping this question. This is very simple one, right? So we are trying to cover more typical type of question which require little bits understanding. Yeah, this question is more frequently asked. Please go through it. So the question is asking you, we are learning a super important concept, and this is related to option trading, right? This question is related to option trading. Super important concept, right? The Greeks. So the question is, in advanced option pricing framework, which risk parameter specifically quantify a derivative sensitivity to change in the volatility of the underlying asset? How much the derivative is sensitive to the change in volatility of the underlying asset? Option they have given gamma, vega, theta, alpha. So which option do you think is correct? So basically the correct answer, think about it. Option, basically they are talking about the advanced option pricing framework. So derivative sensitivity to the change in the volatility of the underlying asset. The answer is vega, right? What is the answer? The answer is vega. Why? Because vega tells us how much the price of an option changes if the volatility of the underlying asset changes by 1%. Try to understand. Suppose volatility changes by 1%. So it tells us how much the price change. How much the price of option changing. Volatility changed by 1%. In simple word, vega measure volatility risk. Means how sensitive the option price is to the market uncertainty. See, this volatility means what? Market, it clearly indicate, market uncertainty, right? It indicate market uncertainty. And this time, this thing, indicate the option price. Means vega measures how much, volatility risk, how sensitive the option price is to the market uncertainty. Let me give you one example to illustrate the concept of vega. See, suppose there is an option, right? This is to the context of option. Suppose there is an option which is priced at 10 rupees when the volatility is 20%. This 20% is what? Volatility. This is the price. Price is 10 rupees, volatility is 20%. Now suppose volatility increased to 21%, right? And the option price increased to 10.50 rupees. So that extra, how much extra? 0.50 rupees extra. That extra 0.50 is due to the Vega, right? This extra 0.50 is due to Vega. So higher Vega means option price move more when market volatility change. See, this 20% and 21% indicate the volatility of the market. So basically, suppose our Vega is higher. So Vega is higher, what does it mean? It simply means that, that bond price will move more when the market volatility change. And trader use Vega to manage how much volatility exposure their portfolio have, right? So let's look at the options. Option A, they have given gamma. That's wrong, because gamma measures how much the delta of an option change when the underlying asset price move. You can think of gamma as an acceleration of delta. For example, if the delta changes fast when the stock price move, gamma is high, but it has nothing to do with sensitivity or volatility. So it is not the correct answer. Gamma is wrong. What about theta? Theta is also called time decay. You can also call it time decay, right? Theta tells us how much an option price will drop as the time passes, even if nothing else changes. How much the value of option price will drop, that is called time decay, right? You might have heard the word. Have you heard the word time decay? So this time decay is what is indicated by theta. For example, suppose the option near expiry, its time value melt away. So that is theta in action. But again, this is about time. This is not about the volatility, because in this particular question, it is centered around the volatility. The question is asking you to about volatility. So theta is not the answer. What about alpha? Alpha measure the excess return compared to the market benchmark. I think we have done one question based on it previously. So you must know all these parameters, gamma. So see what I am doing here, right? I'm not just telling you the correct answer and moving away. No, I am explaining each and every option so that you have conceptual clarity. Suppose in the upcoming examination they ask you about alpha, you must answer. What is the alpha? In simple word we can say alpha is the excess return, right? Excess return compared to the market benchmark, and it is mostly used in portfolio performance. So alpha is how much better you did than the market. It is not about volatility or sensitivity. So remember, option number B is the correct one. Let me summarize what we have discussed just now. So whenever you see this word Vega, it represents the sensitivity to volatility. Right. Sensitivity to delta, theta means sensitivity to time decay, and alpha means excess return. Right. So these are the four parameters which are related to the option pricing. Right. Now friends, let's look at the next question that we have. So the question is asking you regarding this question is regarding a corporate bond. So a corporate bond having face value of 1000 rupees, pay annual coupon at 8%. If similar bond in the market are offering a yield to maturity of exactly 8%, what will be the most likely price of the bond in the secondary trading? There are four options they have given: above 1000, below 1000, unpredictable, exactly 1000. So let's see what is the correct answer. The correct answer to this question is, first of all, try it on your own. And let me explain. The correct answer to this question is exactly 1000. Option number D. Why? Because try to understand the coupon rate they have given of the bond. How much is the coupon rate? Let me just explain here. Okay, so I can write it here also. As you can see. So the correct answer is option number D. Why? Because coupon rate they have given 8%, right? And the market yield means what investor currently expect to earn, that they have also given 8%. So Y to maturity, yield to maturity means what the what is the meaning of YTM? Means what the investor currently expect to earn. They expect to earn 8%, and coupon is given 8%. That means investors are happy getting the same return from this bond as they can get from the market. Investors are quite happy because they are getting 8%, right, from return from this bond as they can get from the market. So the price, so the bond price will trade at par. It's called trading at par or trading at the face value. That is what the word we use. Right. So let me give you one example to make it more clear. Suppose you buy a bond worth rupees 1000. You buy a bond worth rupees 1000 that pay 80 rupees per year. That pay 80 rupees per year. That is exactly what 8% of 1000 is, isn't it? Okay. So basically, you bought this bond, and if the market is also offering 8% return, how much return market is off? This is the coupon rate. This is the coupon, and the YTM means market is offering also 80 rupees per year or 8% return. So there is no reason to pay more or less. It is the perfectly match, right? That's why option number D is exactly correct. What about option C? Option A say above 1000. See, this would happen only if the bond coupon rate is higher than the market price. See, whenever coupon rate is higher than the YTM, then only this par value pricing of the bond will be above 1000. For example, let me give you one example. See, these things are very important from understanding as well as examination point of view, because bond is the most important topic. They ask question every year. Let's say that a bond paid 10% interest rate. Okay, but the market is just offering how much? Market is offering 8%. So this is our coupon rate and this is our market rate. So as you can see, it is 10% and it is 8%. So coupon rate is higher than YTM. In that case, what would happen? Investor would love this bond because it gives extra income, isn't it? Because it is giving extra income, so investor would love this bond. So they are willing to pay more. Maybe they are willing to pay 1050. Maybe they are willing to pay 1100. So this is called, premium bond. Because the return they are getting is higher than the market return. That's why they love, right, to buy this bond, and that's why they are ready to pay premium, right? So this is the point. Very important aspect I'm telling you. So option number A is wrong, right? Option number A is not the correct answer. It's called the premium bond. What if option number B say? Option number B say that the price of the bond is below 1000. Think about it. So this is when this happen, when the bond coupon is less than the market yield. Let me give you one example. Suppose bond pay only 6%. Bond pay only 6%, right? While the market offer 8%. So this 6% is the coupon rate, and this 8% is the YTM. So as you can see, coupon is less than YTM. So nobody wants less return, isn't it? So to attract buyer, the price must drop. Maybe the price can drop to 900 rupees. Maybe the price can drop to 950 rupees until the effective return match. This is called the discount bond. So see, try to understand, when coupon rate is less than YTM, bond price will drop. When coupon rate is higher than YTM, bond price will rise. Why it is rising? Why it is decreasing? Think logically, you will be able to answer. Option number C is unpredictable, but actually, bond pricing follow a clear mathematical logic based on the coupon rate. It is not random at all. So option number D is the correct answer. What is the key learning from this question? Please understand. Let's quickly summarize. Let me just write it down, the quick summary. Please note it down. This will be helpful. See the coupon rate and see the YTM. If coupon is equal to YTM, so this is called par, trading at par. If coupon is higher than YTM, this is called premium trading. This is called bond trading at premium. If coupon is less than YTM, this is called discount trading. Right. So bond price moves opposite to yield change. When yield goes up, price fall down. Right. Please note it down. Very important aspect. Now friends, let's have a look at the next question that we have. This question is related to the European style swaption. Right. This is the favorite topic of IIBF swaption. So question is what is European style swaption in the context of derivative market? Option A, an option granting the right but not the obligation to enter into an interest rate swap only at the option expiry date. B, an option that can be exercised at any time before or on expiry to initiate a swap contract. C, an option where only the seller can choose to enter into a swap after the contract start. D, an option allowing the buyer to modify the terms of an existing swap at any time. So which option do you think is correct in the context of swaption? A, B, C or D? See, if you look at the option number A, it is exactly correct. Because when we see this word swaption, please try to understand. Whenever we see this word swaption, it is made up of two words. See, swap plus option, isn't it? So basically, it means it is an option to enter into an interest rate swap in the future. It's just like an option to interest into it is just like an option to enter into a basically interest rate swap in the future. That's called swaption. Now the question is specifically talks about European. See, swaption means swap plus option. It's just an option to enter into interest rate swap in the future. But the question is talking about what? The question is asking you about swaption. You can say European style swaption. The question is specifically asking you about European style swaption, which means it can be used. I think you know it very well. European means it can be used only on the expiry. E for European, E for expiry. Just remember this word. Okay, so it means it can be used only on the expiry date, not before. So let me give you one example to make it more clear. Imagine that you think that interest rate might goes up. You think that interest rate will go up after 6 months. So what you do? You buy a swaption. You buy a swaption that give you the right. Obviously, swaption will give you the right. It will not give you an obligation because it is a type of option. Right, it will give you a right to enter into an interest rate swap 6 months later. Yes, you can enter into interest rate swap 6 months later. If the rate do rise, you can use your swaption to fix lower rate. If not, you simply walk away. That's why we say right but not obligation. Simple, right? Now let's look at the option that we have. Option number B. Let's look at first option number B. It says that an option can be exercised at any time before or on expiry. That actually describes the American style option, right? This is about the American style swaption, not one in the question. So yes, this type exists. It gives you more flexibility, but the question clearly say only at expiry, which means European style. Hence B is wrong here. What about C? C says an option where only the seller can choose to enter into swap. You can see now, only the seller can choose to enter into swap. That is totally wrong. Why? Because in option it is the buyer who has the right and the seller has the obligation. So the seller does not get to decide anything. They just wait to see if the buyer exercises it or not. What about option D? Option D say an option allow the buyer to modify the terms of an existing swap. That is completely wrong. Swaption is about starting a new swap, right, in the future, not changing an existing one. So this one is also incorrect. So which one is correct? Correct one is option number A. Yes, this is exactly correct. Because swaption, European swaption is a kind of swap plus option, right? So basically option to enter into interest rate swap in the future. That is what we call swaption. And remember that I told you, right, to enter into interest rate swap only on the option expiry date. So remember the difference between European and American option. American option can be exercised any time before the expiry, whereas European option can be exercised only at the time of expiry. Please remember it. So friends, what we learned from this question, let's quickly summarize. Let me just write it down. So what are the keywords? What are the key points that we have just gone through? I told you about, swaption. So swaption means, two words just combined together. Let me show you. It means, swap plus option, right? It gives the right but not the obligation. If it is European, remember, if it is European swaption, it can be exercised at only at expiry. It can be exercised only at expiry. And if it is American swaption, it can exercise any time. You can exercise it any time before expiry. And it is used for hedging interest rate risk or speculating on rate movement, right? You can think of it like a future deal on interest rate. If it benefit you, go for it. If it not benefit you, skip it. That's it. I hope it is crystal clear. Now friends, let's look at the next question that we have. Yes, so this is the next question. In the context of an integrated treasury setup within a financial institution, what does a vertical integration most accurately signify? Right. So basically this question is to the context of vertical integration. So in the context of an integrated, as you can see the word they have written, integrated treasury setup within a financial institution, what does the vertical integration signify? So option they have given the merger of front, middle and back office operation under unified procedure, oversight and shared technology system. B. Combining all the regional treasury into a single head office for better geographical coordination. C. Pooling only those treasury units which handle similar asset class. D. Separating dealing room from risk management and settlement activity. So tell me, what does vertical integration signify? Which option do you think is correct? See, whenever I say this word vertical integration, what I mean to say, it means that all the level of treasury operation. So what does it mean? All the level means, front level, middle office, back office, they work together as a one single unit, right? Please try to understand. Vertical integration means all the level work together as a one single unit. That's the meaning of vertical integration. Let's break them down. Please understand. So first of all, what is the role of front office? If you look at the role of front office, they does the actual trading. Yes, actual trading is being done at the front office. Question may ask you, what are the role of front office? So actual trading is being done. What is the role of mid office? They manage the risk, they manage the compliance, they manage the limits, right? And what is the role of the back office? So back office does handle the settlement. So settlement process are handled at the back office, and also they handle the record keeping, right? Record keeping. So front office actual trading, mid office risk, compliance and limit, and back office deals with settlement and record keeping. So whenever a bank follow vertical integration, these three parts use the same policy. That is the meaning of vertical integration. Try to understand. To the context of vertical integration, all these three parts use the same policy. They use the same policy. They use the same technology system, right? They use the same reporting structure. That's the peculiarity. I hope it is clear, right? So let me give you one example to make it more clear. Imagine that earlier each office worked on its own software and report. Earlier what used to happen, that each office worked on its own software, Each office we are having it on software, on report, right? Front office working on Excel, right? Mid office working on another system, and back office working on paper file, right? So earlier, each one has been on system. Again, I'm telling you, front office on Excel, mid office on another system, and back office on paper file. But vertical integration means now, all three uses one common platform. They follow the same rule. They report to the same management system. This avoid confusion, duplication, and error, making treasury work smoother and safer, right? So that is the correct one. So what is the correct answer to this question? Yes, option number B is the correct one. Combining all the regional treasury into a single head office for better geographical coordination, right? So no, option A is the correct one. Option B says combining. See, that sounds good, but it's not vertical integration. This is more like, geographical centralization. This is more like geographical centralization because it is dealing with location, right? Not with the integration of process like trading, risk, and settlement. It is dealing with location. That's why this is not completely correct. Option B is incorrect. Option C say pooling only treasury unit which handles similar asset class. So that is not vertical integration. That is, product based grouping. This is what? This is product based grouping, right? For example, merging all the forex desks together or all the bond desks together. So vertical integration, however, connect different functions, not similar function. So this is incorrect. What about D? Separating dealing room from risk management and settlement activity. That is actually opposite of the vertical integration, right? This is called, segregation of duties, which is important for internal control. See, option number D is talking about, segregation. Segregation of what? Segregation of duties, right? Which is important for internal control, but not what we mean by vertical integration. So this is also incorrect. So what is the correct answer? Correct answer is option number A. So remember, whenever they ask you about vertical integration, just add these: front plus middle plus back, right? They are working as a team. They are together working as a team. Same procedure, same policies and IT system. It reduces silos and improve efficiency. It ensures strong governance and a smooth information flow. It focuses on process integration, not location on or product grouping. You can think of it like a relay race. Instead of running separately, all these offices now pass the baton perfectly. I hope you like this simple breakdown. Now friends, have a look at the next question. The next question is asking you that according to the RBI norm, if a scheduled commercial bank has a capital fund totaling rupees 2000 crore, what is the maximum it can borrow in the call money market on a given day? Options they have given: 3000 crore, 2000 crore, 1000 crore or 2500 crore. So see, basically how much can the bank borrow in call money market in one day? That is the question. See, option number A, look at option number A, 3000. It looks tempting, right? But it is wrong. Because RBI has clearly said that bank can borrow up to, so what is the RBI say? RBI regulation says that, bank can borrow up to 100% of its capital fund. 100% of its capital fund in the call market. So suppose if the capital fund is 2000 crore, as you can see here. So it means, borrowing 3000 crore means 150%, which is above the limit, right? This will increase the risk and RBI does not allow that much leverage. So this is incorrect. What about option B? Yes, this is absolutely correct. RBI clearly say that, a scheduled commercial bank can borrow up to 100% of its capital fund in the call money market on any single day. 100% of capital fund in the call money market in any single day. Please remember it. So that means, it can borrow 2000 crore maximum in one day in the call market, not 2001, not 2500, 2500, exactly 2000. Option number C is also wrong. 1000 crore is wrong because maximum is 2. When question is asking you maximum, that's why B number option is correct. Okay, so key points to remember that if you talk about the call money, what is the meaning of call money? Call money means very short term borrowing, right? Call money means short term borrowing and usually one day. Usually the borrowing is for one day. RBI limits say maximum borrowing is how much? You can say maximum borrowing is 100% of the capital fund. That is the maximum borrowing, right? And capital fund includes two things. Capital fund includes, paid up capital plus reserves plus surplus. See, whenever I say capital fund, you see this word they have written. See, three things are there in the capital fund. First of all, paid up capital plus reserves plus surplus, right? These three things combined together form the capital fund, right? So 2000 crore capital fund is the maximum 2000 crore borrowing limit. So always remember, borrowing limit in call market is 100% of the capital fund, and capital fund includes capital reserves and surplus, right? I hope you remember this one line, that borrowing limit in call market is 100% of capital fund, right? Let me again write it down, right? So remember, let me write it down. This will help you. So remember, limit borrowing limit in call market. Borrowing limit in call market is 100% of capital fund. Please remember it. 100% of capital fund, that is the borrowing limit. Okay. Now friends, let's look at this question. When purchasing a bond between coupon dates in secondary market, what does the term dirty price represent? Right. So the question is about the dirty price. So we will clear one of the most commonly asked bond market question. What is dirty price? Sounds complicated, don't worry. By the end of this slide, you will know it exactly. So what is the meaning of dirty price? Option A says that clean price plus accrued interest calculated from the last coupon date up to the trade settlement date. Option B says that the market value minus accrued interest from the start of the bond tenure. Option C say clean price plus accrued interest from the settlement date to the next coupon date. Option D say clean price only with no adjustment for interest. So that's the question. What is the dirty price? See, let me give you one example to understand it. Option A, yes, this is the correct one. Why? Let's make it simple about the dirty price. This is the most frequently asked question in the examination, and you can understand it very easily. Imagine that you are buying a bond, and this bond pay interest. It bond pay you interest every 6 months. Okay, it pays you interest every 6 months. Now suppose the last interest was paid 3 months ago. Last interest was paid 3 months ago, and you are buying the bond today. Okay, last interest was paid 3 months ago. You are buying the bond today. So the seller held the bond for those 3 months, which means the seller deserve interest for that period, right? See what I'm telling you, that you are buying a bond that paid interest every 6 months. Suppose the last interest or coupon was paid 3 months ago, and you are buying the bond today, right? So the seller held the bond for those 3 months, which means seller deserve interest for that period, and that is called accrued interest. That interest is called accrued interest. Now the bond clean price is the quoted market price without interest. So whenever you see this word clean price, what does it mean? It means the quoted market price, what they have quoted. Quoted market price is called the clean price, and this does not include any interest. But when you actually pay it, you add this accrued interest to the clean price, right? So that's why dirty price become clean price plus accrued interest. Clean price plus accrued interest. So that is the actual price that the buyer pay in the market. Let me give you one example to make it crystal clear. Let's suppose that clean price is 98 rupees. This 98 rupees is the clean price. Okay, and accrued interest is 2 rupees. 2 rupees is the accrued interest. So what will be the dirty price? The dirty price will be 100 rupees, isn't it? It will be 100 rupees. That is what you actually pay, right? So that is the option number A. Option number A says the same. The clean price plus accrued interest calculated from the last coupon date up to the trade settlement. Yeah, this is the correct one. What about option B? The market value minus accrued interest from the start of the bond tenure. See, option number B is incorrect because we never calculate interest from the start of the bond. Only from the last coupon date we calculate, right? Only from the last coupon date. So remember, we never calculate interest from the start of the bond. Only from the last coupon date we calculate. The start of the tenure could be year back, which make no sense for current pricing. What about C? C says clean price plus accrued interest from the settlement date to the next coupon date. This one sounds tricky, but notice the term period they have given. From settlement date to the next coupon date, which means future interest, which has not been earned yet. Right? It is just like future interest. Future interest has not been earned. So we only add interest earned till today, not for the future month. So this one is also wrong. What about option D? It says clean price only with no adjustment for interest. This is actually the definition of the clean price, right? Not dirty price. Dirty price always include accrued interest, which clean price exclude it. So friends, let's summarize the key point what we have covered here. So clean price, whenever you see this word clean price, just remember this word quoted price of the bond, what they have quoted. That is called clean price. And then you will see the word accrued interest. Accrued interest means what? Interest earned since the last coupon date till today, right? So last coupon date last coupon date, you see what was the last coupon date until today, how much interest you have earned, right? So that interest is what we call accrued interest. Second point. Third point, you can say dirty price is equal to clean price plus accrued interest, right? Plus accrued interest. So dirty price is the actual amount that the buyer pay to the seller in the market. Suppose you buy a 1,000 rupees bond halfway through the 6 month interest period. You will pay half the interest to the seller as accrued interest. So the total price you pay is the clean price plus interest price, that is called the dirty price. So remember, next time someone asks you what is dirty price, just say it is not messy. It is just the full price that you pay, which includes clean price plus accrued interest. If this explanation helped you to understand, please hit that like button. Now friends, have a look at the next question. So today we are going to talk about something that every trader, especially those in treasury or dealing room, must understand. That is called, stop profit level. This question is asked most frequently. What does the stop profit level mean in the context of trading dealer activity? Sounds technical? Don't worry. By the end of this slide, you will know in the simplest possible way. So option they are saying it is the minimum loss that must be recorded at the end of each session. Option B, it refers to a stage where accumulated gain must be logged in and position should be closed. Option C, it is the total revenue generated by the dealer in the trading week. Option D, it is the profit threshold required for eligibility to trade in the next market cycle. So let's look at the option number A. What do you think about option A? It is wrong. Why? Because this is the total opposite of what stop profit means, right? Stop profit is about, locking profit. Remember, stop profit is about, let me write it down. Stop profit is about, locking profit. Okay, so not recording the loss. The term that relate to limiting loss is actually a stop loss. See, what is option number A saying? That minimum loss that must be recorded. See, this is the stop loss. This is called, stop. This is not called stop profit, right? So this is the opposite of what is stop profit. A stop profit is about locking in profit, not recording loss. This question is option A saying loss recording loss. So this option is incorrect, right? Because the stop profit has nothing to do with losses. Option number B, it refers to a stage where accumulated gain must be logged. Yes, that is the correct one. Let's make it super easy. Let's make it super easy using one example. I'm giving you one example to make it more clear. Let's say that you are a dealer. You are a dealer and you are trading in government bond. Okay. Now you made a good profit. Let's say rupees 10 lakh profit you make. And your organization has a rule that says if the profit reaches 10 lakh, right? Book it. If a profit reaches 10 lakh, book it. Don't wait for more. So the 10 lakh profit is your what? Stop profit level. It is your stop profit level because your organization say that whenever your profit reaches 10 lakh, book it. So even if the market might move further in your favor, you close your position and lock the profit because the market can reverse anytime. It is just when you are gambling and someone say, "Bhai, ab nikal ja," you are in profit. Don't risk losing it again. So stop profit means, a pre-decided point where you exit with profit to protect your gain from turning into loss. It's all about discipline and risk management. I hope this is clear, right? What about option C? Option C is, it is total revenue generated by the dealer. No. Revenue means total money earned. That is more like a sales. That is more like an income, not a stop profit. A stop profit is like a limit, right? Is like a limit point. It is not a total number. So option number C is obviously incorrect. What about D? D says it is a profit threshold required for eligibility. There is a point they have written that trading eligibility. You can see they have written trading eligibility. You know it very well that trading eligibility does not depends on how much profit you made earlier, right? Trading eligibility has nothing to do with profit. It has nothing to do with profit you made earlier. A dealer trade as per the daily strategy and limit. Dealer trade as per the daily strategy as well as the limit. This option is also incorrect. So what is the correct one? The correct one is option number B, right? So remember, stop profit level is the fixed profit point where the dealer must close the trade and book the profit. That's it, right? And purpose is to protect earned profit from being lost due to sudden market reversal. Suppose market got reversed and whatever I have earned, it is on verge of losing. So I don't want that. I booked my profit. That's it, right? There is a point. So think of it like playing a game. You have won a good amount before you get greedy and lose it all. You decide, bus, I'm cashing out now. That is your stop profit. So I hope it is crystal clear now. Stop profit. Please hit the like button if you think that the way I am explaining is helping you understand the concept. Now friends, have a look at the next one. The question is asking again question for bonds. You can see the bonds is the most asked question, repeated question in the examination. Question they are asking you, when comparing bond with the identical maturity, how does the market price of a floating rate bond, so it is start talking about floating rate bond, typically respond to the shift in interest rate compared to a fixed rate bond. So basically on one side you have floating rate bond, other side we have fixed rate bond. So market price of a floating rate bond responding to the shift in interest rate, how? The question is that. Option A say that floating rate bond shows greater price swing than fixed rate bond. Option B say that floating rate bond remains stable while fixed rate bond are more sensitive to rates. Option C say both type experience equal price change. Option D say that fixed rate bond experience less price movement than floating rate bond. So let's look at the option number A. If you look at the option number A, is it correct? No, it is not correct. Right? Why? Because floating rate, this is incorrect. Because this is actually the opposite. Right? This is actually the opposite. Because floating rate bond don't swing widely. Their price are stable. Remember, floating rate bond, their price are stable. Their price are quite stable. Because their coupon. Why? Because the coupon, obviously bond have a coupon. Because their coupon, that means the interest payment, keep adjusting with the market rate. There is no reason for the price to fluctuate a lot. Right? So remember, very important thing I'm telling you, that to the context of floating rate bond, remember their coupon, right, or the interest payment, they keep adjusting with the market rate. Coupon adjust with the market rate. So there is no reason for the price to fluctuate a lot. So price does not fluctuate a lot. It is the fixed rate bond that sees bigger up and down in the price when interest rate move. So that's why option A is wrong. What about option B? Option B say floating rate bond remain relatively stable, whereas fixed rate bond are more sensitive to rate change. What do you think about it? Let's understand this with a simple example. Yes, this is the correct one. So let me give you one example to make it more clear. Suppose that you buy a fixed rate bond that pay 8% coupon every year. Right, every year it pay 8% coupon. Now if the market interest rate rise to 10%, new investor can earn 10% easily. So your 8% bond become less attractive, isn't it? It become less attractive. Result is that its market price will fall down. That to maintain the equilibrium. On the other hand, suppose we have a floating rate bond. You have taken a floating rate bond. So what will happen? It automatically increases its interest payment as the market rate rises. So its return stays in line with the market and price does not fall much. That is why so you can see now in the fixed rate bond stability is not there, because as suppose market interest rate rises to 10%, automatically bond price is falling. But in the case of floating rate bond, there is nothing such like that. It's quite stable. Right? So return stay in line with the market. That is why floating rate bond are say price stable, while fixed rate bond are rate sensitive. So remember, this is a very important thing. This question is asked, difference between floating rate bond and fixed rate bond. So question may be asked that which is more stable. So answer is floating rate bond is more stable as compared to fixed rate bond. Option C says that both experience equal price change. No, that is wrong. Because the whole difference lie between these two bonds, lie in how their price respond to rate change. See, basically rate is changing, right? And since rate is changing, how price is responding. That is what floating rate and fixed rate bond decide. Option D say fixed rate bond experience less movement than floating rate bond. This is totally opposite. Fixed rate bond actually experience more price movement. So this option is also wrong. So what we learn from this discussion is that fixed rate bond they pay constant interest rate. Right, fixed rate bond they pay constant interest rate. Price fall when market rate rise and price rises when market rate fall. While floating rate bond interest adjust with market interest rate, price remain relatively stable. I told you now, in the case of floating rate bond, price remain relatively stable. And in the rising interest rate environment, just remember it, in the rising interest rate environment, floating rate are preferred. They protect investors from price drop. So suppose interest rate is rising, such an environment is there. So which one will you prefer? Floating rate or fixed rate? Obviously floating rate you will prefer. This concept is key in the interest rate risk management. Right? So you can think of the floating rate bond like an auto adjusting fan. Right? You can think of it like just one example to remember it. You can think of floating in rate bond like auto adjusting fan, right? If the room get hotter, it speed up automatically, while fixed rate bond are like manual fan. It stay at one speed no matter how hot it get, so you have to suffer when the environment change. That's it. This is the way to remember it. Now friends, have a look at this question. Very good question it is. Friends, again I am telling you, if you want study material for CTP examination through which you can easily crack the examination in the first go, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. Right, now see this question. The question is, a risk desk manage a long call option portfolio worth $8 lakh with a delta of 0.30. To achieve a delta neutral hedge, what action to the desk take in the underlying asset? So the option they have given you, right? Buy $24,000 of the underlying. B, short sell $2,40,000 of the underlying. C, buy $2,40,000 of the underlying. D, short sell $24,000 of the underlying. So very good question. First of all, you must understand what the delta means. Here you will see this term, as you can see, delta. How much delta they have given? 0.30. What does it mean? Let's first understand delta. So whenever I say this word delta, please understand delta. It means how the option value change. It indicates how the option value changes when the underlying asset price change. So asset price is changing, how the option value is changing. That is what delta tells you. Right. So remember, for if it is call option, suppose it is call option. So for call option, delta is positive. Call option delta is positive. It means, if the price goes up, call value decrease. Price goes up, call value decrease. That's called delta probability. Means it simply tells you now, if option value change, how the asset price changes. Right. So for call option, delta is positive. Means if price value goes up, call value decrease. Now in this case, you can see delta they have given is 0.30, which means for every $1 rise in the underlying value, for every $1 rise in the underlying, right, the portfolio gain 30% of the move in the value. Right. So there is a formula that you can use to compute it. Let me write down the formula. So your total exposure, you can write it like this. Your total exposure is equal to portfolio value multiplied by delta. Just remember it. Total exposure is equal to portfolio value multiplied by delta. Now in this case, how much to portfolio value they have given? Portfolio value they have given I think it is $8 lakh, and delta they have given 0.30. Just do the calculation. So portfolio value I am just writing here 8 lakh multiplied by 0.30. How much would that be? That would be $2,40,000, isn't it? So this means your portfolio behave as if you own $2,40,000 worth of the underlying stock. Right? Your portfolio behave as if you own this much. You own $2,40,000 worth of the underlying stock. Your portfolio is behaving as it. Right? Now, second thing to understand, what is the meaning of this hedge? Right? What is the meaning of this hedge? Hedge means since you are long call, you can see now you are long call option. You can see what they have written, long call. Since you are long call, you already benefit when the price rise. Price is rising, you are benefit because it is a long call option. To make your position delta neutral, which means not affected by price movement. When I say delta neutral, it means not affected by price movement. To make the position delta neutral, you need to take an opposite position in the underlying. That means you have to short sell, right? So what is opposite of long call? Opposite of long call is short sell, right? So you have to short sell $2,40,000 worth of underlying asset. This will offset the delta and make your portfolio neutral to the price change. So this is the correct one. Option number B is the correct one, right? $2,40,000 short sell of the underlying. That make his option number B correct. So I hope answer is clear. Just remember this formula, very important. Delta equivalent is equal to value of position multiplied by delta. This will help you understand the concept. So you can think of delta hedging like a balancing a seesaw. You might have seen a seesaw, right? So you can think of it like balancing a seesaw. So your call option tilt it to one side, and to balance it you put an equal weight on the other side. When both are equal, no matter which way the market move, you will stay steady. That's it. That's called delta equivalent. So in short, we can say, just let me write it down. In short, just let me make summary. You can say that that long call positive delta, right? So what is the learning from this question? Whenever long call is there, our delta is positive, right? How can we hedge it? We can hedge it by sorting. We can hedge it by sorting the underline. Right. We can hedge it by sorting the underline. That's it. Right. I hope this is crystal clear now. Now, friends, let's look at the next question that we have. While designing an index-linked bond portfolio, the question is, while designing an index-linked bond portfolio, which risk is most closely monitored to ensure that fund performance replicated benchmark as accurately as possible? While designing, and so the question is, index link, this is the key point. Index link bond portfolio you are designing. Which risk is most closely monitored to ensure that fund performance replicated benchmark as accurately as possible? Option they have given: concentration risk, tracking difference risk, credit spread risk, and regulatory risk. See, if we talk about the concentration risk, when it happened? It happened when the portfolio is too heavily invested, right? Concentration risk happen, when portfolio is too heavily invested in few security, right? Your portfolio is too heavily invested in few security, increasing the risk if those security underperform. This is not our main concern in an index linked portfolio. Here we are talking about, index linked portfolio, because the focus is on, replicating the benchmark. You can see performance, future fund performance replicated benchmark. This is our main focus, right? So this is wrong. What about option B? Option B is saying tracking difference risk. Yes, this is the correct one. What does it mean in the simple word, tracking difference, or we can say either we call it tracking difference risk or we can call it tracking error, right? So tracking error, it measures how closely your portfolio follow the benchmark index. See, you have your portfolio, right? And you have your benchmark index. So tracking index, basically what it does, it measures how closely your portfolio follow the benchmark index. And for an index linked fund, the goal is not to beat the benchmark, but to mirror it as accurately as possible, right? The goal is what? The goal is to mirror it as accurately as possible. Let me give you one example. It will be clear. Suppose that benchmark index, benchmark index, it goes to 5% in a month. In a month, it goes to 5%. And if your portfolio, so again, I'm telling you that benchmark index is suppose 5%, portfolio grew only 4.8%. The difference of 0.2% is the tracking difference. So there can be many causes of this tracking error, like transaction cost, timing of trade, slightly different security selection. So portfolio manager monitor this carefully to make sure that fund return are very close to the benchmark. That's why, option B is the correct answer. What about option C? Credit spread risk? No, because credit spread risk is the risk of bond price changing due to change in the credit worthiness of the issuer. Here, what matter? Issuer credit worthiness. How much credit worthy is the issuer? And the bond price is changing because of that, right? So while important in general bond investing, in the case of index linked bond portfolio, right, the main goal is tracking the index, not worrying about the outperforming based on spread. What about regulatory risk? So regulatory risk is the risk of losses due to change in the law or regulation, right? It is important for fund manager, but it is not the primary risk. So what is the main risk? Is the tracking error, which measure how closely your portfolio mirror the benchmark. For index link or passive fund, the goal is replication, not outperformance. A small deviation can happen due to transaction cost, timing, or security selection. You can think of it like a recipe, exactly, right? So benchmark is the exact recipe. So your benchmark is the perfect recipe. You can think of it like a recipe. Benchmark is a perfect recipe, and your portfolio, it can be like, dish that you cook. So tracking difference is the slight taste difference if you miss a pinch of salt or add sugar too much. That's it. I hope it is crystal clear now. That is what we call tracking error. Now, friends, if you want me to continue more, I will bring the part 3 lecture also in the upcoming session. Just write yes in the chat box, in the comment section. I will bring the part 3 because we have series of question available, right? So I will try to make you clear. If you think that our video is helpful for your preparation, and if you want any kind of PDF, again I am repeating, you can WhatsApp me on this particular number, right? Number is on your screen for any more detail. So please subscribe the channel, hit the like button, and hit the bell icon. Whenever I upload the next video, you will get the notification instantly. Thank you.